Thanks for joining me today. This is Russ Irizarry. This is short sale training video number 6, the financial and credit effects of a short sale. The content in this presentation should not be considered legal or tax advice. Okay, so what are the financial and credit effects of a short sale? The credit effects of a short sale are less damaging than that of a foreclosure. In a short sale, the closure of the account will show as account settled on your credit report. It'll show as account settled for less than amount owed or account settled for less than full balance. Um, and this is proven by the Fannie Mae guidelines. With a short sale, you will be eligible for Fannie Mae backed mortgage after only 2 years versus 5 years with a foreclosure on your credit report. So, in general, with a short sale, you will be better off credit wise. And this is an actual credit report after a short sale. The particular lender here was Chase Manhattan Bank, and you can see right here it says the account was legally paid in full for less than the full balance. Okay, so credit wise, the account shows as a settled account, and that's to your benefit versus a foreclosure. Okay, a deficiency judgment. There is a risk that the bank can pursue a deficiency judgment for the shortage, that being the difference between the total mortgage owed and the actual sale amount of your property. Um, in Florida, the state where I do business, the bank has 5 years um, after the closing of your home to pursue a deficiency. However, most lenders are not pursuing deficiency judgments on short sale approvals. What they're doing typically, in my experience, is sending you the 1099 instead. And a 1099, they'll send you a 1099 for the amount of the deficiency judgment. Um, Important to note that if you were to go to foreclosure or just let your property go back to the bank, the lender can still pursue a deficiency um, after the home goes to foreclosure for the difference between the judgment amount against you and the REO sale price, what the home eventually gets sold for. So the benefit of doing a short sale is that you have the opportunity to negotiate with the bank to not pursue a deficiency. But if you let the property go to foreclosure, you don't get the opportunity to have the bank waive that. Just an FYI, in the state of Florida where I do business, certain assets are protected from a deficiency judgment. These include your homestead, your primary residence, life insurance policies, annuity contracts, pension and profit sharing plans, IRAs, disability income, and prepaid college plans. Again, this isn't legal advice. See your attorney for details. And one of the things we ask for when we're negotiating a short sale is that the lender give you a full satisfaction of lien or that the lender waive its right to pursue a deficiency. Basically, we ask the lender to not come after the shortage. So if they don't come after the shortage, what they're going to do is send you a 1099-C for the amount of the debt forgiven, and they're going to send you that in the year after you do the short sale, because you're going to need to file that 1099-C with your tax return. So in this example, let's say your mortgage balance is $450,000, and your home is only worth 300. That's what it sells for. That means you have a shortage deficiency of 150,000. Assuming that the bank does not pursue this 150,000, then what they're going to do in the year after your short sale, they're going to send you a 1099-C showing 150,000 as income or debt cancellation. In the eyes of the IRS, debt relief equals income to the seller. Okay. However, oh, and this is an actual uh, 1099-C, cancellation of debt. You can see here in this particular example, the amount of debt that was canceled was $128,000. And this is the 1099-C. The owner will receive this in the year after the short sale, and this is what it looks like. Um, in 2007, Congress passed the Mortgage Forgiveness Debt Relief Act, and that eliminates taxation on debt forgiveness on owner-occupied homes, and this applies to debt forgiveness, debt forgiven between 2007 and 2012. So in the example we just discussed, if a bank sends you a 1099-C for $150,000, you would not have to pay income tax on that property if it was your primary residence. Okay, primary residence being keywords. Okay, so just to reiterate, um, if the bank does send you a 1099 like this, showing debt canceled, if the property was your primary residence, you're not going to have to include this amount of debt relief in your income. Okay, if the property was not your primary residence and you received that 1099-C, then what you're going to have to do is use a form 982, okay, and you're going to have to show insolvency at the time that the property was sold to avoid having to pay tax on that 1099-C. Okay, this is not tax advice. I am not a CPA, although I used to be. But I'm not giving you tax advice here. I'm just letting you know what your options are if the property that was short saled was an investor property as opposed to the primary residence. Okay, what you have to do is use a Form 982. That's the end of this presentation. If you want more information on the foreclosure process and your options, and short sales, please go to my website, www.shortsalemymortgage.com. Okay, at that website, you can download a free report. It's 33 pages entitled How to Stop Foreclosure with a Short Sale. Thanks very much for watching this video, and we'll see you on the next one.